Welcome to GRE. I'm your host, Keith Weinhold. There's a concerning trend for real estate investors that's gaining traction. A review of how the 5 ways real estate pays is going today. Then I talked to the president of a prominent national mortgage lender who deals specifically with investors on some key trends and the state of the lending market amidst higher interest rates today on Get Rich Education. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4plexes. So start your pre-qualification and you can chat with President Caeli Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Kingston, Jamaica to Jamaica, Queens, in New York City, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. Before we bring in Ridge Lending Group President Caeli Ridge to tell us about today's mortgage lending landscape, including I'll ask her about whether higher mortgage rates mean fewer refinancings and therefore layoffs and staff downsizings like some lending companies have done, there are some important real estate investing trends that I want to tell you about first. And they're not all good. Are you going to be banned? Canceled? Will you be banned from participating as a real estate investor in the United States? I think I shared with you recently that just last month, Justin Trudeau's administration in Canada announced an outright ban on foreign investors buying homes in Canada in an effort to keep their booming housing market from overheating. Okay, that's just foreign investors. And Canada is also instituting a higher tax for those who sell their homes within a year after buying them. All right, that part would make flipping less profitable there. Now, could we see these sorts of trends pour over into the United States, influenced by our neighbors to the north up there, where American real estate investors could be banned from buying homes? I mean, after all, in the U.S., investors have bought 33% of homes on the market this year. And, you know, a lot of laws have both positive and negative outcomes. What about the problem of, say, when you cannot buy a home in the place in which you grew up because you can't afford that home there anymore yourself, or even rent there yourself? I mean, that's sad to see that. Some people have to end up moving away from where they were born and raised, breaking their roots. That breaks up extended family connections. You know, it just always seems kind of sad to me to not be able to afford to live where you grew up. Well, here we go. Last month in California, Democratic Assemblyman Christopher Ward introduced what's called the California Housing Speculation Act. And what that does is it aims to discourage the flipping of properties by short-term investors by adding a tax on profits from sales that occur within 3 years of the purchase. Okay, so that's flippers, but think about that. Think about how that might affect turnkey real estate providers. Now, much like in Canada, there have been rumblings in some U.S. states about imposing similar limits on investors, including New York and New Jersey. And one more surprising place where a proposal has been made is in the Dallas area, and that's a region where the population has been exploding. In Dallas, at last check here, leaders aren't considering banning out-of-area real estate investors, but they are examining a limit on the number of homes that investors can buy there. So this is a trend that I track. I'm going to keep my eye on it, and I'll try to inform you as I learn more. Generally, I would be surprised if this ever ran rampant in what I call cash flow country, those markets that we tend to invest in. These are the same investor-friendly markets that also refute rent control, for example. They spurn those sorts of interventions into the free market. And when it comes to what we do here at GRE, buying rental property in investor advantage markets, well, since we don't tend to buy in those pricier US places, then you and I, we're not really doing so much to fuel the trend of making markets so unaffordable that you can't live there. You and I tend to invest in those lower cost markets in places like Indianapolis, Indiana, and throughout Ohio, Central and Northern Florida, Alabama, Memphis, Tennessee, Little Rock, Arkansas, some parts of Texas and Oklahoma and Iowa and Missouri and some others. But it's places like this. So when you see trends like this emerge, like limiting how many properties investors can buy, that's legislation that you generally correlate with other places other than that list that I just mentioned. And don't get it wrong, you are an asset to America because you provide others with clean, safe, affordable, and functional housing. Although, yes, it's not as affordable as it used to be, but that is a big part of our mission here at GRE. Now, there's another trend that you already know about because I've been talking about it here for a long time, and that is the work from home trend. And, it came up again last week with our guest that comes more from the commercial and multifamily world, but he really highlighted the significance amidst all the other trends that are going on, that the work from home trend really has staying power. Now, you already know that the work from home trend has increased the usefulness and hence the value of all residential properties. But there's one phenomenon about the work from home trend that you might not have contemplated yet. As at least, I'll call it this phase of the pandemic has wound down, employers are often asked if they can come in and return to the office. In reality, though, not all workers can. See, consider that if workers no longer work from home and do have to come into the office, sometimes they cannot afford to come into the office. And what do I mean by that? Workers that leave their home setup to come into the office 1 day a week or 2 days a week or 5 days a week, now that worker has expenses for gasoline. They might have higher expenses for meals. Now they might have to incur new expenses like parking that they didn't have to incur at home. And now here's the big one. Work from home types that have to come into the office might have to pay for childcare. That's a giant expense that they did not have when they worked from home. So remote work began in 2020 as a precautionary measure, but now it's a cost-cutting measure. Returning to work has a negative impact on a lot of people's finances. And what about when the federal student loan repayment moratorium ends on August 31st? If that's not extended again, well, that new payment in people's lives could make it more imperative that more people want to work from home to cut costs. So my point is that some people cannot afford to go into the office. There is a chance that in your entire life, residential real estate has never been more important. That's really one of the base cases for why we like investing in this. Now, when we talk about work life, you might have seen a number of stories these past few months about how mortgage companies have cut their staff. Yeah, there have been layoffs. They've reduced staff because with higher mortgage interest rates, the refinance business has largely dried up. So I'm going to ask Caeli Ridge if that's happened there at Ridge Lending Group before she and I talk more about mortgage trends as well as some great mortgage products and customizing that right mortgage product type specifically for a real estate investor. She'll describe the all-in-one loan, and it works a bit like a checking account against your property, and it does have an adjustable rate mortgage. You're going to want to listen closely to that. First, let's update the 5 ways real estate pays in today's market. Number 1 is appreciation. You are clearly crushing it there as many markets are still up 20% year over year. Therefore, if you were to put a 20% down payment on a property 1 year ago, since your leverage, you would be up 100% just off the first of 5 ways you're simultaneously paid appreciation. The second one is cash flow. Now, for new purchases, cash flow is clearly down, as these higher rents do need time to catch up to the higher prices if they ever do. Some buyers might need to make a 30% or 40% down payment in order to get cash flow. The third of 5 ways is that loan pay down made by the tenant. That tenant paying down a portion of your principal for you every month. Well, that is still historically high because mortgage rates are still historically low, but they're sure not as low as they were 1 year ago and 2 years ago. We'll get into that with Caeli Ridge next. The fourth of 5 ways you're typically paid simultaneously with real estate is that generous basket of tax benefits. Little has changed there. And then the fifth and final way is that inflation profiting benefit that you have with your long-term fixed interest rate debt. You're obviously crushing it there with inflation near 40-year highs. So there you go. Of the 5 ways, 3 of them are historically high, 1 of them's historically low, and then another one, the taxes, that's fairly unchanged. I think that good opportunity is lost on a lot of people. People that don't listen to this show aren't aware of that. And if you compare that to other asset classes in the market where so much is down this year, stocks are down, gold hasn't done much price-wise despite high inflation, cryptocurrencies have taken a particular clobbering this year. Bitcoin off its high from late last year, off more than 50%. Real estate is still where it's at, and the low housing supply keeps supporting it. There is one premier mortgage lender out there that's helped more families realize their dreams of financial freedom, more so than any other lender in the entire nation. I speak with their president next. This is Get Rich Education. For accredited investors, if you've ever wanted 10 to 12% passive income returns, Wagner Nolasco and his professional partners could have the right answer for you. With real estate, one of the safest assets available on the planet. On a preferred return basis, you collect your money before anyone else does. I encourage you, go ahead, learn more about their opportunities at I'mAccredited.com or text 305-684-2222 for your free investment guide. Hey, my friend Damian Lupo informed me that checkbook IRAs have been made illegal by the U.S. tax court. If you have a checkbook IRA, your holdings are now disqualified with taxes and penalties up to 50%. But don't panic, Damian and the EQRP company can fix this. Those IRAs can be converted into EQRPs retroactive to last year, getting those tax deductions and reducing your taxable income. In this way, you can invest your 401k or IRA in real estate, Bitcoin, gold, and even your own business. So whether you're a full-time investor or retired or even a dentist with dozens of employees, if you're listening, you qualify, the EQRP works. It's the solution. You'll control your money, kill UBIT, and pay way less taxes. To learn more about this strategy and free up your retirement money, get the newest EQRP special report. Text GRE to 307-213-3475. That's text GRE to 307-213-3475.
This is Rich Dad Advisor Ken McElroy. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
I'd like to welcome in Caeli Ridge. She runs Ridge Lending Group. They lend for investment property in almost every U.S. state, and they've now funded over 45,000 properties. They're real estate investors themselves there, and what they really do is they get in there and they structure your current and your subsequent loans correctly for you. So it's really about this long-term planning and vision for real estate investors. Welcome back to GRE, President and CEO Caeli Ridge.
Keith, it's so good to see you. Thank you for having me. I always love being here with you and your listeners.
Yeah, it's so good to have you back. So much has changed since we last had you here. Noticeably, we have higher interest rates. Now, prior to this, we had higher prices, and higher prices oftentimes want to make savvy investors do something like a cash out refinance and get a hold of that equity and maybe redeploy it, what I often call equity harvesting. But now with higher interest rates, perhaps some of that refinance appetite has gone away. For example, you often see media reports of some mortgage companies laying people off with this decreased appetite for refinancing. So in the midst of these higher mortgage interest rates with the refinance business probably going away, what's really going on in there at Ridge, Caeli?
So we're actually not seeing too much of a decline for our investors, right? Investors, regardless of the rate, oftentimes will continue to harvest that equity because borrowed funds are non-taxable. The return on whatever they're borrowing relates to whatever that new return is, counterbalancing the increased payment. And I might just go back just a little bit. I think you and I talked about this last time we were together. Interest rates are funny, and people tend to have short memories related to interest rates. So 2019, we're probably right around where we were then, right? Fast forward about 3 years. So rates aren't, well, yes, absolutely. They're higher than what we've kind of been a little spoiled with over the last couple of years. They're back where they were 18, 19. So for our perspective, maybe there's a little bit of a decline. I really haven't noticed all that much. Investors are still getting at that equity and out there deploying it for more acquisition.
Now, I want to ask you what you think about rates coming back down. And this is kind of like being able to predict the future with a crystal ball. It's a lot like asking what the S&P 500 is going to do tomorrow. So really, why don't I frame it in a way as what would it take for rates to come back down in your mind?
There's so many variables that can dictate an answer to that question, and some of them are subjective. I would tell you that currently the two things that I see are most prominent that would create that yield would be, one, the continued war in Ukraine. A lot of times, historically speaking, significant volatility to the stock market, and war is almost at the very top of that list of what can create that, will create a space where investors will flee from the volatility of the stock market and run into the safe haven of the mortgage bonds. When that happens, we see interest rates improve. Now, that has not transpired yet. I've been kind of on the sidelines waiting for this. I think that the stock markets believe that this might be short-lived, the war over there. And then in some cases I'm hearing and reading, maybe that isn't the case. So that could be one thing. And then the other thing, obviously, recession. A lot of news outlets, everyone's reporting that we're headed that direction. If and when we get there, some people are saying we're in it now. That also can tamper rising interest rates. But the Fed has been very clear that they're going to continue to help with inflation, continue to raise that Fed fund rate, which might be useful just to comment for your listeners. The Fed fund rate is the daily trading rate between banks, intra-trading between banks. It's not the same as the long-term rate. While they're connected, they're totally different things.
Right. Long-term mortgage rates being more closely tied to that yield on the 10-year T-note. When it comes to the rate of interest rates, you gave us some context earlier about 2019. Of course, when we look at a longer-term history, Freddie Mac will tell us over the last 50 years that the average rate has been something like 7.8%, still substantially higher than it is today. But of course, we do need to keep in mind that we are substantially higher now than January of 2021, when mortgage interest rates reached all-time lows. But in there, knowing that you serve investors, you actually have a product that helps investors reduce the amount of interest that they pay with an all-in-one loan. And that's something that we haven't talked about recently, Caeli. If I can, when it comes to an all-in-one loan, I think it gives you some flexibility. It's not quite like an interest-only loan. Oftentimes, you can describe an all-in-one loan as a first lien HELOC, a first lien home equity line of credit. So for those that aren't familiar with an all-in-one loan, tell us about it.
So I'm going to give you guys high-level stuff because this can get pretty technical. But you're right, an all-in-one. The reason it's called all-in-one is it doubles as both a mortgage in the form of a first lien HELOC and your checking and savings account. We've combined a mortgage and a checking and savings where simply your depository income is used to drive down a principal balance, saving the amount of interest that can accrue. Because in any HELOC, interest is accrued daily based on that day's principal balance and that month's fully indexed rate. So the lower the balance, the less interest can accrue. So as you're using this as your checking or savings account, if let's just say, I like to give examples. Let's say you have a balance of $100,000 and you have income of $10,000. And for this example, we'll say that you get your $10,000 on the first day of the month. You're going to deposit that into your checking account. Nothing changes about your banking features whatsoever. Totally the same as you have today. So for as long as you can leave that 10,000 in against the 100,000, making it 90,000 for as many days of a 30-day billing cycle as possible, the interest accrual will be that much less. There's a compounding effect that's at work here. The second compounding effect is going to be your monthly savings, your discretionary income. Let's use it further to take this example. Let's say 10% of your 10,000 a month is what you're saving on average a month. So that 10,000 stays in there. You have full access to it 24/7, just like you would otherwise. And on the second month, your starting balance is 99,000. So when you put in your $10,000, we're down at 89,000 for say 29 days out of a 30-day billing cycle. What a lot of investors will do is they're going to use a credit card to pay all their monthly expenses. And I mean down to a stick of gum, food, gas, utilities, cell phone, mortgage payments, all go on this credit card and leaving your 10 grand in there. Before the credit card accrues any interest, you simply go online to your online bill pay off the credit card and rinse and repeat every day, or every month rather, day on month. So it's a very unique model in which it kind of creates a scenario where you become your own bank. You're controlling the amount of interest that can accrue on a daily basis based on depository income from all sources. It'll greatly reduce the amount of interest that you'll pay. But I think more than that, the interest savings on this is fantastic. I really think that the all-in-one is uniquely qualified to really support investors because you've got this line of credit for 30 years that you can access, pay it down, draw it out, pay it down, draw it out for your down payments. You could do the BRRRR method on this thing, and you're using the gross rents along the while with your depository income. All of that should be used to really continue to save interest and have this line of credit. No pre-qualification. You're not paying closing costs again unnecessarily, right? So it's kind of a unique model and one that's not as well known. It's a little bit more sophisticated, so it takes a minute for people to wrap their heads around it. In fact, I've shared with a lot of people that I've been in finance for a long time, 25 years in fact. And when this was first introduced to me, I had to look at this thing for a week before the light bulb went off. So it is unique. It does take some extra time. I don't know how far down the rabbit hole you want me to go. So I'll stop there and you can ask me whatever follow-up questions came from that.
What I think is helpful to people is comparing the features and benefits of this all-in-one loan that you've just described to what they're used to, the plain vanilla 30-year fixed amortizing loan. With the 30-year fixed amortizing loan, if you decide to make an extra principal payment of $10,000 for whatever reason, you might do that. Your payment amount is exactly the same the following month. And you cannot get that $10,000 back out unless you apply and qualify and potentially pay fees. So therefore, in a lot of senses, the 30-year fixed amortizing plain vanilla loan is a one-way street. Once that money goes in, it's illiquid and it's difficult to get that back out of there. Over here with the all-in-one loan, you're telling us about its flexibility, about how you can basically deposit funds into it and go ahead and extract those out, basically borrowing against your home again in a small increment.
Absolutely. It's the difference between closed-ended, 30-year fixed, amortized, and open-ended, variable, revolving HELOC. So they couldn't be more different from one another.
To talk more about the all-in-one loan, okay, so we do have that potential risk of the ARM, the adjustable rate mortgage that one needs to consider. With an all-in-one loan being a lot like a first lien HELOC, typically with HELOCs, the borrower has the option of making interest-only payments if they choose to. Is that what's happening here with the all-in-one feature?
Yes, and this is where I think people get hung up. This is where I got hung up because technically there's no payment due. You're simply depositing your income from all sources and you're driving down the principal balance and the interest cannot accrue the way it normally would. So let's say that you start with a limit, a line limit of $100,000, and you start with a balance of $50,000. There's no deposit due at all. You could simply let that thing ride if you chose to. That's not what it's intended to do. But in terms of payments being due, there isn't one. You could continue to let interest accrue, and that $50,000, zero deposits are being made, would just continue to increase because the interest accrual would go on top of that. The only time an actual payment is due is when the balance is about to exceed the limit. Does that make sense?
I see. Okay. So yes, that offers even more flexibility than what I thought, and even more flexibility than an interest-only loan where you need to make at least the interest payment monthly.
Yeah, it's pretty slick. It's actually very popular. The clients that we have secured this loan for, without exception, have all come back and been very, very happy with the decision. Now, I will comment that this is not for everybody. The discretionary income is going to be important. So based on your income and your spending habits, If you have at least 10% left at the end of the month, that's typically what we find is where the all-in-one makes more sense, especially if you're comparing it to a 30-year fix, for example. If you're looking at the two side by side and trying to compare apples to apples, it'll tell you whether it makes more sense for this individual to go for the all-in-one versus a 30-year fixed. If you have $50 left at the end of every month, the all-in-one probably isn't going to be to your advantage. You're probably better served with a 30-year fix. So it's individual. It depends on those variables, but more often than not, we find that the all-in-one is a very unique, very powerful tool for real estate investors.
Now, is the all-in-one loan, could that apply to one's primary residence as well as income properties? And then tell us about the interest rates.
It absolutely can. It can go on a primary residence, a second home, or an investment property. Generally speaking, we want to advise the primary residence because you get a little bit higher leverage in that case, 80% to be specific. And also your primary is usually going to be the higher value. So your line limit is going to be higher and have more access on a primary. All three are applicable. The interest rate is going to be, like we've discussed, variable. So there's two components there that we need to account for. There's a margin and an index. The margin on a primary residence, and the margin, by the way, is the fixed portion of those two components. The index is the variable part. That's the one that can move based on how that particular index moves. And the index for this loan is the 1-year average CMT. It's the Treasury. It used to be the LIBOR. That's been replaced with the 1-year average CMT because Brexit, LIBOR is phasing out. Margin on the primary is 3.75. The current index is posting at 2.04. I can't do mental math. I can do it on the non-owner because that one's easy. The margin on a non-owner occupied or investment property is 4%. The index still 2.04. So the fully indexed rate today for a non-owner occupied on the all-in-one is 6.04. Important to add that there are rate caps associated. There's a floor rate and a life cap. The floor rate on a non-owner is 4.75. So that means that no matter what happens, the interest accrual will never be less than 4.75. The life cap, the reverse to that statement, the max it can ever go, is 6% over the initial fully indexed rate. So if we were closing today, 6.04 plus 6, 12.04 would be the life cap in that case.
All right, so just to keep it real simple, the index plus the margin equals one's interest rate on the all-in-one loan.
Correct, called a fully indexed rate, exactly right. I am a big fan of both adjustable and interest only, especially for real estate investors. If I'm going to try and statistically argue the points where people kind of get hung up on a 30-year fix, I would share with them this. The shelf life of a 30-year fixed mortgage is between 5 and 7 years.
Right.
Usually the shorter end if it's an investment property. And the other thing to note is that the statistic historically says that the individual that starts on day one with a 30-year fixed mortgage and makes 360 payments later is less than 1%. I try to educate people and have them look at it from a logical standpoint versus the emotional, psychological of that fixed rate, which is never going to come to fruition. So I'm a fan of the adjustable rates for those reasons when we're in a regular market. The interest only also for investors is just offering so much more flexibility. And in fact, one can actually pay off a mortgage faster, usually with an interest only, than they can with an amortized loan. Because remember, the amount of time that you're locked into that rate, the more interest you're going to end up paying. As an example, let's keep using the easy math of 100,000. If you're on a 30-year fixed loan and you started with 100,000, in 30 years, you're going to end up paying closer to 200,000. It's usually double what the initial principal is. So you could rapidly, if that's what you chose to do, I'm not a big supporter of paying off cheap mortgage debt that somebody else is paying for. But if you wanted to accelerate the payoff, you could do so quicker with an interest only than technically on a amortized fixed rate loan.
We're talking with Ridge Lending President and CEO Caeli Ridge. She's joining us from Tucson, Arizona, by the way. If you notice, her background looks somewhat different. We're hoping she doesn't get pricked by a saguaro cactus at any time during the chat here. As long as that doesn't happen, we're going to continue talking about mortgage loans in today's environment. You bring up a great point, Caeli. One thing that a lot of real estate investors and just lay people don't understand is, in a sense, you're paying a premium interest rate to get 30-year fixed certainty. Therefore, with an ARM, adjustable rate mortgage, you would therefore expect a discount, a lower interest rate. But of course, that does introduce the risk depending on how long your interest rate stays fixed at the beginning of that ARM period and so on. Like you said, almost no one takes a 30-year fixed rate mortgage and they never refinance it and they never sell their property and take that all the way to term. 30 years, 360 payments, less than 1% of people. We've been talking about the term interest only a little bit. And sometimes I think that throws people off when we talk about, are you able to make an interest only payment on this or that? So if I can, just with a really simple example here, I had talked about this a few weeks ago, and it really made some light bulbs go off rather in some people's heads. If you have, say, a $1,300 monthly mortgage payment, $300 each month goes toward the principal and $1,000 toward interest, some people seem to think, oh, with an interest only loan, that's just a $1,300 payment that goes toward interest. No, that's not how it works. Just in general, what happens with an interest only loan is you have the option of not paying the principal of $300 and you can only pay the interest of $1,000 if you so choose, but you still have the option of paying down principal at this level or even above this level. So it really enables people to think like an investor rather than a saver. Some people are like, now, why would I ever do that? Well, what you've just done is if you cross this principal payment out and you don't make it, you've just increased your cash flow by $300 and you have not reduced your equity by $300. So really what you've just done is you've transferred your equity into cash flow. Well, congratulations. That's the financial freedom formula. You have the option with an interest-only loan. That's something that a lot of people don't get.
And I would add to that too, and encourage people to kind of go online and find an amortization table. And on a 30-year fixed mortgage, what you're going to see is month by month, the amount of your payment that's actually going to principal in the first 10 years of any 30-year fixed is this much. You don't really even start paying the principal back until the later end of that loan. So that's another incentive to kind of going back to what we said. If we know that the shelf life of a mortgage is typically 5 to 7 years, and you know that the first 10 years of a 30-year fixed mortgage is 95, 99% interest, it really kind of helps build the case for the interest only.
Interest-only loans can make sense in some situations. They don't have all the advantages. For example, I paid 0.25% more in interest to have this interest-only payment flexibility above a like amortizing loan.
But the math again, so if you're looking at, let's say, 5.25% interest only versus 5% principal and interest, your payment is going to be less on the interest only and your cash flow will be better, obviously, on the interest only. The math. Remember, guys, do the math.
Do the math. Interest-only loans got a really bad name during the global financial crisis because for a lot of people, that's the only way that they could qualify for a property with the lower payment of an interest-only loan. So, of course, you, the individual investor, want to check and make sure that you're not getting in that same situation. Interesting, Caeli, something that we've never talked about on the show before. Another loan type that got a lot of people in trouble during the global financial crisis are negatively amortizing loans. Tell us what those are and if you think they'll ever become available again.
As far as I know, no. I don't expect to ever see those again in my lifetime. We didn't do them back in the day. We certainly wouldn't offer them again today. A neg am loan means that you're paying less than, so there were usually payment options, a 15-year, a 30-year, an interest only, and then I think it was the fully indexed below. And it would allow you to create a situation where the LTV, it's called neg am, it's like a start rate payment, where the balance would exceed the value of the home up to 115% in some case. So if you owed, for example, if the value of the property was $100,000, this neg am option could make it so that your minimum payments would actually increase the loan debt to $115,000. So you owe $115,000 on a property that's valued at $100,000. That's a problem. That's a neg am loan. Very dangerous type of financing and not something that I would recommend for anybody.
A neg am loan where your principal balance actually increases month after month. That's something that got a lot of people in trouble. Caeli, you serve these all-in-one loans like you've described earlier, but of course you also do like a 30-year fixed amortizing loan, what we call a conventional loan for real estate investors. When one does any of those loan types with you, what are the interest rate lock periods like?
They get to choose. The longer the lock period, the higher the rate. But the options today are a 15-day, a 30-day, a 45-day, a 60-day, and we can even lock on a 90-day. The 90-day lock will be the 60-day rate plus a quarter. So they have that option for new construction or rehab or whatever if they're worried about volatility and interest rates. So all of those are available. Again, the longer the lock, the higher the rate, but as short as 15 and as long as 90.
Okay. With supply chain disruptions, that's something that some people are more concerned with. So it's good to hear that you have the flexibility for some pretty long interest rate locks and options that way. What if someone's interest rate lock expires?
More often than not, we can usually buy a few days for free and not charge the client. But once a lock expires, typically speaking, there are extension fees that are equal to 0.02% of the loan amount per day. So on $100,000, 0.02, $20 a day would be the extension fee for as many days as we need to extend.
So some real flexibility that way with the interest locks. Caeli, you typically deal with investors that are buying properties out of the state that they live in. Oftentimes that's where the best deals are. Oftentimes those deals tend to be in the United States, Midwest and South, but there sure are some outlying areas too. And you offer loans in 46 states. So tell us about that loan closing process, maybe for people that aren't familiar with buying across state lines.
There's some people too that just have a comfort level of wanting their banker in their backyard, et cetera. But I'll share with your listeners that the chances that our client is either in the state that we're in or in the state that they're buying properties in is probably 1% or less. Very, very rare is that the case. We're very systemized and adept at handling all of the transactional ins and outs and setting up the notaries. And it's pretty seamless anymore with technology. Very, very rarely do we find that we're actually in contact physically with our clients and where they live and where the property is.
Now, in the past, I've had a mobile notary, a human being that comes and either shows up at my home or shows up at my office, and we just do the closing right there, called a mobile notary.
Yeah, anywhere really. I mean, we've had people be on vacation in Hawaii with their family, and we arrange to have the mobile notary meet them at their resort, or really wherever, at the airport. We've had notaries actually head to an airport and meet clients there. So there's a whole lot of flexibility on making sure that signing piece, once the transaction is complete, it could really happen anywhere.
People must want an income property really bad if they're losing a portion of a day on Maui in order to get it done, but whatever it takes sometimes. So that's how easy it is to transact across state lines. Well, Caeli, you've done a great job of laying out the flexibility of this product called the all-in-one loan, where one could basically deposit money into it against their home and borrow it back out again if they choose to. And you also offer more conventional loans. Are there any last loan types that you'll offer to investors that sometimes they aren't thinking about or that they don't know to ask about?
We're proud that we're not a one-size-fits-all. We really do have a diverse offering of loan programs. So we've talked about the conventional, the all-in-one. Non-QM is a very diverse product line in and of itself, not just for investors. Anybody really that doesn't fit into one of the other boxes. Bank statement products, debt service coverage ratio, asset depletion. We have short-term bridge loans for fix and flip, or those that need renovation rehab dollars to finish an investment. Commercial products, which apply to commercial properties, obviously, which is anything over 4 units. But commercial, actually, some people are surprised to know that can actually apply to residential. It's called cross-collateralization. If you wanted to take 10 single-family residents and put them into one commercial blanket loan, that would apply there too. So pretty diverse mix there that we can offer our investors.
Yeah, see, and this is the planning that I discussed earlier, how they'll take a holistic look at your portfolio and really help you sequence these loans and consolidate things at times and really operate more efficiently as an investor. Caeli, if someone wants to learn about the all-in-one loan or any of all these other mortgage product types that you have, I'd like you to tell them where they can find you, because Ridge Lending Group is where I have done my last few purchase loans for income property myself. It's where I've done my last few refinancings myself. So let them know where they can get started.
Yes, sir. So you can reach us in several different ways, everybody. You can go to our website, ridgelendinggroup.com. You can even apply online there. You can email us info@ridgelendinggroup.com, and you can certainly call us anytime. 855-747-4343. 855-74-RIDGE is the easy way to remember. And we look forward to speaking with each and every one of you.
Caeli, keep enjoying that sweet Southwest scenery there. Thanks so much for helping our listeners for so long like you have.
My pleasure, Keith.
Yeah, Caeli makes a good point there. Despite higher rates, which means some companies laid off their staff, investors are still going to harvest equity because they think like investors. It's those owner-occupant homeowners that tend to think more like savers and think more of this debt-free mindset. They're the people that are averse to refinancing at higher rates in order to get some liquidity out. And yeah, that's why you read about those more typical mortgage companies announcing layoffs. That makes complete sense. The advantage of dealing with someone like Ridge, and the reason I use them for my own loans, is how they help you sequence your loans with regard to what your real estate objectives are. Maybe it's better to earn more income this year or more next year instead. Or maybe it's better to buy 2 properties this year or 0 properties this year rather than 1. And when it comes to the all-in-one loan type that we discussed early in the chat, there is a great loan simulator where you can go ahead and plug in some numbers yourself to see how much interest, if any, that would save you. And I'll endeavor to put that link directly to that all-in-one loan simulator in the show notes for you here. Otherwise, you can get started at ridgelendinggroup.com. You'll also find the simulator over there. I'll be back next week to help you build your wealth, real wealth building in the real world with real estate. I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.